Hello everyone. Welcome to CFA Level 2 Review for Equity Investments. My name is Jeff Chang and I will be going through the section for free cash flow valuation. So right about now you're probably right in the middle of your studying and you're probably going through and all your friends are going out and having fun and you're inside studying. Just think about, keep your eye on the prize, all right? Think about, actually getting your charter. And when you actually get your charter, I can tell you it's a very big certificate. And it comes with customized frames that you can buy. All right, so keep your eye on the prize. Think about actually getting your charter. Don't worry about all your friends going out, all right? They'll still be there, hopefully, when all of this is done. All right, so let's talk about free cash flow valuation. All right, this is pretty much bread and butter of the CFA kind of equity section, one of the main points that you really have to hit. It's one of those things that if you don't know free cash flow to equity, free cash flow firm, just don't go to the exam because it's that important. All right, these are points that you basically have to have. All right, so we're going to jump into this, and here we go. Now, introduction to free cash flow. What we're going to talk about is the difference is that dividends are actual cash flows that are actually paid to the stockholders, whereas free cash flow is the cash flow available for distribution each year after you subtract out spending on capital expenditures, working capital, or another way to say capital expenditures, fixed capital investments. The way you want to think about this is that a company is a cash-generating machine, and how much of that cash is thereby available both to the bondholders or the equity holders, depending on whether you're looking at free cash flow to the firm or free cash flow to equity. So let's define free cash flow. So what we have is free cash flow to the firm, which is the cash available for both shareholders and bondholders after taxes and after capital investment and working capital investment as well. So if you're talking about, what is capital investment or capital expenditures, you're talking about purchases for property, plant, equipment, buildings, land, keeping the business running, working capital, things such as inventory, things that are locking the cash up. And keep in mind, this is going to both the debt holders and the equity holders. This is a pre-levered cash flow, meaning there is no interest expense. In fact, interest expense is actually added back to net income to arrive at free cash flow to the firm. And the next one is free cash flow to equity. Now, this is cash available to the equity holders after payments to the bondholders. So this actually subtracts out the interest payments. This is the post-leveraged cash flow. It does not equal the actual dividends paid, whereas it's the free cash flow available to the equity holders after you pay off interest to the bondholders. Now, the strengths, this valuation method, extremely popular, and the strengths is used with firms that have no dividends. If they pay no dividends, it's very difficult to value using a dividend model. It's a functional model to assessing alternative financing policies, and it's basically a rich framework that provides additional detailed insights into the company. Where are they, how are they in the generating cash? How volatile is that cash amount? Right? What are the trends of that cash? And then other measures, you have EBIT, EBITDA, and cash flow from operation either double count or they emit certain cash flows, things such as capital expenditures. Just because, if your piece of machinery within the company is deteriorating and you have to buy a machine every year or every couple of years, that may not be factoring into those values. And we'll see in more detail in later slides on how they differ from EBIT, EBITDA, and cash flow from operations. All right. Actually interpreting some of the free cash flow limitations. Well, if cash flow is negative, it can actually go negative due to large capital demands, because this one does include, like I said, capital expenditures. When you buy that piece of equipment, when you buy that building, while the company may actually be profitable, a large purchase of a fixed asset during a particular year can actually make it go negative. It requires a detailed understanding of accounting because you're using accounting data to actually arrive at free cash flow. And we're going to see how that calculation actually works. And information may not be readily available or published, and some of the information that you're actually looking for you may not find available. That is also a limitation. So let's talk about free cash flow to the firm versus free cash flow to equity. All right, keep in mind the firm value under free cash flow to the firm is discounted at the weighted average cost of capital. Because why? Because remember, free cash flow to the firm is cash flow available to both the bondholders and the equity holders. And weighted average cost of capital factors in the cost of capital for both debt and equity. Under the equity value, what we're looking at is free cash flow to equity, and we will discount it based off the required rate of return of equity, right? Or there's many different ways that we've seen in level 1 as far as you can use CAPM. What is investors demanding as far as the required rate of return? We discount it at the required rate of return of equity. When we use free cash flow to equity when the capital structure is stable. Because why? Because if essentially today I have no debt, and then tomorrow I raise $1 billion in debt. And if I raise that $1 billion, what's going to happen to interest expense? It's going to go up. And then the very next year, I pay off that debt. Then there's going to be no interest expense, right? And so what ends up happening is free cash flow to equity then becomes unstable because of this moving capital structure. Now, I'm going to use free cash flow to the firm when it's high, or there's a high level of debt, or changing debt levels, just like what I talked about before. Because of that, as the debt is changing back and forth, then interest is going to bounce up and down. But free cash flow to the firm is immune to that because I'm adding back interest expense. I'm looking at the cash flow available for both the bondholders and the equity holders. So, like in the previous slide talking about, how do I get the equity value from free cash flow to the firm? Well, if I get the firm value, so keep in mind, firm value from the free cash flow to the firm, I subtract out the market value of the debt, and what is left? The value of the equity. Free cash flow, from an ownership perspective, because under free cash flow to equity, we're talking about from a control perspective, all right? Because you can actually change the dividend policy. You don't really, you're indifferent whether or not, essentially, if the cash is remaining in the company or if it's outside of the, or if it's paid out to you, because if you control the board, you can dictate that dividend policy. Whereas if you're not in a controlled perspective, and you're a minority owner, the dividend discount models may be more appropriate because you don't have that ability to change dividend policy. So keep in mind, so free cash flow equity is in a control perspective when you're exercising significant influence or control within the company. Now, as a dividend discount model, you're valuing minority positions in a publicly traded shares, and you don't have the ability to actually change that dividend policy. So let's take a look at free cash flow formula references. All right, we start with net income. Net income is basically, you'll find this on the financial statements, and it is after preferred dividend, but before common dividends. All right, so we're subtracting out preferred. Now, there are non-cash charges. We'll go over these in detail. There's a whole list of them that we're going to go through. Interest 1 minus the tax rate. This is the after-tax interest. Net fixed capital investment. As we go through these slides, I'm going to call this just CapEx, and I'm going to write it just like this, CapEx, meaning capital expenditures, and I'm using the E. You'll see in a second on why. So my fixed costs, capital investments are my capital expenditures. My working capital is my working capital investments, things such as inventory, accounts receivable, places where my cash will actually be locked up. And my net borrowings basically are any new debt minus any debt repayments. Keep in mind, why am I going to need this? Because technically, and this happens all the time, a company, if interest rates are really low and their yields are really low, they can raise debt and pay dividends to the equity holders. That then becomes cash flow available to the equity holder. So net borrowings, when you raise debt, that is still cash available to the equity holders. So we'll see in a second, we'll need this to be able to add it back to free cash flow to equity. Now, non-cash charges. if you remember from level 1, the cash flow statement, a lot of these are going to look really similar. So as we go through this, really kind of dig back into your indirect method of the cash flow statement. These non-cash charges were are going to be almost identical to what you saw there. Now, this applies for those free cash flow to equity, free cash flow to the firm. Both of them have to adjust out non-cash charges if you're starting with things such as net income as you make adjustments to that. These represent adjustments for non-cash decreases and increases in net income based off of accrual accounting. What does that mean in English? Meaning that if you made income but you didn't receive cash, you recognize the income but no cash came in. Well, that means that you can't count that portion of net income in your free cash flow to equity or free cash flow to the firm. Or you accrued an expense, but you actually didn't pay cash. So that cash is still available to pay debt and equity holders. So if non-cash charges decrease net income, you add them back to net income. If they increase net income, we subtract from net income. So let's take a look here. Here are your non-cash charges. You have depreciation, impairment write-down, gains and losses on assets, restructuring expenses, deferred tax liability, which you would add back, amortization of bond discount premium. All right, so let's go through some of these that we would find. And notice they're in different locations, whether it be the income statement or cash flow or on the cash flow statement. So depreciation and amortization are non-cash charges, right? They don't represent cash. So you're going to add those back. Impairment write-down. Think about an impairment. You're going to take an impairment loss, so net income is lower, but there is no cash event that's actually occurring. You haven't actually sold the asset. Gains and losses on assets of early debt or early debt retirement, any types of gains and losses, while they are in net income, they actually don't represent as far as cash. Well, if you're thinking about it, this confuses candidates sometimes. It's like, well, wait a minute, I sold a building at a gain, and I got cash for that gain. What do you mean that I have to subtract or add back the losses? You got cash for selling that building, but you will have accounted for that building in capital expenditures, because that is the net capital expenditures, what you sold, what you bought. So you can't double count that cash. And in order to avoid that double counting, because you're going to count that building sale in net capital expenditures, you have to remove the gains and loss effect that's within net income when you make the adjustment. So for gains, you're going to subtract. Losses, you're going to add back. Restructuring expenses, you're going to add those back. Deferred tax liability, you're going to add those back because they represent essentially taxes, that income tax expense that you actually have not paid cash for, right? So in the case of accelerated depreciation, you recognize the income tax expense, but you are able to deduct more. Now, there's also amortization of bond discount or premium. You're going to add back discounts and you subtract out premiums. Notice the locations are all over the place. Keep in mind, level 2 is in vignette format. So I may give you just a set of financial statements and they're just going to say go, right? And you're going to have to know all of the adjustments that you have to make. Now, what we're going to go through in a bit is I'll have a trick for you to basically go through to see, hey, what is it that you're going to need to do? What are some of the adjustments that you're going to need to make? All right? Now, let's go further into net fixed capital investments, or what I call your net capital expenditures. Your investments in fixed capital represent cash outflow necessary to support the company. Because keep in mind, when you buy, let's say, a piece of machinery, while you're capitalizing it, and it hasn't hit the income statement the day you buy it, but that expense starts to come through depreciation, it still represents. Now, depreciation is a non-cash event. If I'm just looking at cash, then this portion has to be taken into account. It is viewed as this capital expenditure, and notice capital expenditure reduces both free cash flow to equity and free cash flow to the firm. This can include even acquisitions of intangible items such as trademarks, patents, so on and so forth. Care should be used with non-reoccurring large acquisitions. So If it's something that's not going to reoccur in the future, this perhaps may not be something that you want to put in your particular model. Looking at the net fixed capital adjustments, you can actually find your net capital expenditures on the investing activity section of the cash flow statement. Remember, your cash flow statement is cash from operations, investing, and then financing. In that investing section is where you're going to see your net capital expenditures, where they actually spent cash to buy capital assets, and then capital assets in which they actually sold. Now, from the balance sheet, you can actually find your net capital expenditure by using the ending net property, plant, equipment, your beginning property, plant, your beginning and ending balances, depreciation, and your gain or losses on any sales. Don't worry. Let's take a look at the next slide. This is how we kind of break this formula down. Now, you'll notice what we have here is you have your beginning and ending net property, plant, and equipment. Now, what are some things that increase or decrease property, plant, equipment? Well, depreciation decreases it. If you sell anything, it decreases it. And if you buy anything, it increases it. And what our target, what we're looking at, is we're looking for any additions where someone had bought a particular fixed asset, or if they had sold a particular asset, which is essentially cash coming in. Right? So I'm looking for additions and proceeds. These are the two answers I'm actually looking for. I add those to, subtract those two from each other, I get my fixed capital investment. So you'll notice if I give you the beginning and ending property, plant, equipment, depreciation, and book value of whatever is actually sold, you can actually, through a plug, find what you purchased in your property, plant, equipment. Right? Problem is that book value is not the cash. Book value of disposal is not the cash that you actually got when you sold the asset. What you got was proceeds. But you can back into and find out how much cash you got by adding or subtracting any gains or losses, right? So if the particular asset was sold at a gain, you would add those gains back to get to the proceeds. Or if it's at a loss, you take the book value and subtract that loss, and that will get you how much they actually paid. Now notice, in both cases, if I'm looking for these two numbers, book value of disposal actually kind of cancels out. So essentially, they may not give you this, and your additions and proceeds actually may not be correct in of themselves, but the net of those two numbers, meaning additions and proceeds, will actually be the correct answer, because everything else is just you're just mashing together two plugs. So you'll notice, if I just remove the book value of disposal, you'll notice that all of those, the remaining line items that are in these two kind of calculations are the formula from the previous slide. Now looking at the investments in working capital, working capital includes all short-term operating assets and liabilities, and specifically excludes cash and cash equivalents, short-term interest-bearing debt, notes payable, current portion of long-term debt, and any dividends payable. So these things, typically you're talking about current assets and current liabilities, but notice they're excluding any cash or cash equivalents, because what are we doing here? We're actually doing free cash flow analysis. So it does not, if you're just looking at current assets, current liabilities, it excludes your cash and cash equivalents and any short-term interest-bearing debt as well. All right, looking at the working capital adjustments, there's a direct relationship between changes in liability and changes in cash flow, meaning as the accounts payable, let's say accounts payable is increasing, an increase in a liability is a source of cash, meaning your accounts payable is increasing. That means you're having expenses, but you're not actually paying cash for them. So that's not really hurting your cash flow. You're going to essentially add those back. Decreases in a liability is a use or negative cash, meaning your accounts payable is falling. That means you're actually taking cash out of your pocket and you are paying off your accounts payable. That's cash going out. Your net borrowing adjustment only affects free cash flow to equity, because not free cash flow to the firm, because net borrowing is what you borrowed from the bondholders, right? And while this cash is available to the equity holders, they're not essentially available to the entire firm, because that's the cash they essentially had put in. So Any repayment, you're including any repayment of long-term debt, notes payable, or current portion of long-term debt goes into the net borrowing. Now, just to kind of make sure we're clear on this, while there is in let's say current liabilities, there's the current portion of long-term debt. Remember in working capital, it's not just the current liabilities. While this portion would be in the current liabilities section, this would be accounted for in your net borrowing. Now, your cash flow essentially is the balance sheet change in your debt instrument. Is your debt going up or is it going down? And any amortization, adding back amortization of discounts, subtracting out amortization of discounts, and adding back amortization of premiums. All right? Now, here are your first formulas for free cash flow to the firm and free cash flow to equity, beginning with net income. So you're starting with net income. You add your non-cash charges plus your interest 1 minus tax rate minus your working capital minus your fixed capital expenditures. Then you have your free cash flow to equity. Notice you're adding back net borrowing. Here are the two main differences between the two, if you notice. They essentially equal each other, except one adds back the interest, the other one adds back the net borrowing, or in this case, like it would be very similar to principal, right? And free cash flow to equity equals actually free cash flow to the firm adjusting for those two items, meaning you would subtract out the interest and then add back the net borrowing. All right? Now, you'll notice this formula kind of shows it in a, as far as when you look at non-cash charges. Remember a couple slides ago, there was a lot of them. There were a lot of non-cash charges associated with that. This formula is actually much, much bigger than what we see here. So what I found was as you go through free cash flow to equity, free cash flow to the firm, there are so many things that you have to keep track of, meaning the formula gets really long when you expand out non-cash charges. So what I did was, so I'm a big fan of using mnemonics, meaning if there's a huge formula that you have to memorize, if you guys ever played like Scrabble or Words with Friends, try to make something that represents each portion of the formula. And that's what I'm going to share with you, because this will make kind of our free cash flow to equity, free cash flow firm a lot easier. So I'll share with you. This is how it works here. This is how I actually answer the question. So if I'm going, let's say, free cash flow to the firm, I'm going to start, and the mnemonic that I use, and keep in mind, if you don't like my mnemonics, you can actually make your own. You know, I used to make them bad words. It basically made it easier to memorize, but you know, this is we're keeping it clean here. So this is the mnemonic that I currently use. It's a nice tip, and it makes you glad. All right? What does this equal? So you have a nice tip, and it makes you glad. And I usually draw a line right here, because everything below that line, this whole thing is essentially non-cash charges. Okay? So I start with net income. I add back, essentially, interest times 1 minus the tax rate. Right? And then I subtract out working capital, the C in working capital, and then I subtract out any net capital expenditures. Remember why I made the E really big? Because it is your net capital expenditures. Then I add back deferred tax liability. So the T stands for taxes. Add back impairments. And then for P, what we do is premium. So any amortization of premium, I subtract. And for discount, so this is for premium discount, I add those back. And then gains, I subtract out. Losses, I add back. Amortization, add back. and depreciation. And so I start with net income, and I get all the way down, and then there is my entire formula for free cash for the firm. So what I would do on essentially test day, when I open up the vignette and I realized they're making me calculate free cash flow to the firm, I would just write down a nice tip. And the way I typically think about it is these four are negative, right? So free cash for the firm, there's a nice tip. Start with net income, add back the interest, subtract out the working capital, subtract out the net capital expenditures, add back deferred tax liability, impairment, subtract out premium, add back discount, minus the gain, add the loss, add the amortization, add depreciation. That's a long formula, all right? Some people are really good at memorizing things. I'm not that smart. If you have photographic memory, wonderful. But I use these types of mnemonics to kind of help me what to do from point A to point B. That way, when you're actually going through the vignette, you can write this out. Just you write out a nice tip, Glad, and then as you go through the financial statements, it's kind of a checklist. You're just going to be like Terminator. You're going to look for each of the pieces that make up the formula. All right? Let's go and do free cash flow to equity. All right? For free cash flow to equity, it's going to be really similar because we still have non-cash charges. The mnemonic is actually newbie and newbie tip. And you're still glad. All right? Keep in mind, the P and the G are negatives. And so let's take a look at what these stand for. First one, same thing, net income. Second one, same thing, capital expenditures. Net capital expenditures, that's a negative. Working capital, that's a negative. So these two are negatives. In both formulas, there's essentially four negatives. And then B, keep in mind, notice there's no B on the other side because this represents what? Net borrowing, which you will add back. Right, and the rest is the same. Deferred tax liability, add back impairment, subtract out premium, add back any discounts, subtract out gains, add any losses, amortization, add back, depreciation. Right? Now, imagine on test day, you can just write this out. I'm ready to go. I just go into the financial statements, look for what I'm looking for, calculated it out. Right? Now, what we'll see later is that if you have these mnemonics and you write these out, what we're going to go through is we're going to take pieces of these because technically I could take, let's say, net income and combine it and use some of the non-cash charges and arrive at cash flow from operations, and I could see where the formula actually turns out. But this is the kind of the longest version of the formula that kind of gets you there. All right, so if you also notice, what are the two differences between these two values? This part of the formula and this part of the formula. Otherwise, both formulas equal each other. So if I'm going to go from free cash flow to firm to free cash flow to equity, what I'm going to do is I'm going to subtract out, because I added back interest, 1 minus the tax rate, I'm going to go ahead and take this out, right? Subtract this out. So that way it equates to what we have on the other side, and I'm going to add net borrowing because the left side, free cash flow to the firm, doesn't have that number. And that's how I arrive from free cash flow to the firm to get to free cash flow to equity. All right. Let's go over here. So free cash flow to the firm, you see these are the formulas. Notice the main difference here is breaking out these pieces right here. All right? Now, free cash flow to the firm, free cash flow to equity, beginning with cash flow from operations. You'll notice if I remember cash flow from operations is your net income plus any non-cash charges minus any change in working capital. And it's it's an after interest starting point. So essentially, free cash flow firm is cash flow from operations, interest 1 minus tax rate, minus any capital expenditure or fixed capital investment. And subtracting after-tax interest and adding back net borrowing from free cash flow equation gives you free cash flow to equity. Because remember, net borrowing is essentially what is different because we've already subtracted out interest there. The two adjustments would just be what? Cash flow from operations minus your fixed capital investment. Now, you have two choices. One, you can just memorize these formulas, or you can use the mnemonic to back into your particular question. So let's go to this real quick and write this one more time. So let's start with free cash flow to the firm. And what was the mnemonic again, if you remember? It is what? Nice, tip, glad, right? And see if you remember the four letters that were actually negative. It was what? Your working capital, your capital expenditures, minus your premium, and your gain, right? And these are your non-cash charges. Now, if you were to look at this, the question becomes is, how do I get to cash flow from operations? Well, remember under the indirect method, in the cash flow statement, they started with net income. So this number, cash flow from operations, starts with net income, all right? And it includes changes in working capital, right? Because remember, when you did the indirect method, cash flow from operations increases essentially in current assets, let's say inventory, increases inventory, decrease come out of net income. So that adjustment is there, and then all of the non-cash charges are in cash flow from operations. So if you're telling me this one number, right, cash flow from operations, basically accounts for the N, the C, and the tip glad, that means I just take cash flow from operations, right, and essentially add back interest and minus my capital expenditures or fixed capital investment. So I'll repeat that again. So if you're telling me that cash flow from operations equals everything except for the I and the E, that means I just take CFO, add back interest 1 minus the tax rate, subtract out the fixed capital investment. Let's take a look on how we did. Notice that's exactly what? That formula right there. All right? What about, let's say, free cash flow, if I wanted to go from free cash flow to equity? All right? I start with from free cash flow to equity, right? I go, it is a new B, right? And tip glad. And let's see if you remember in this one, which ones were the negative? They were what? Subtract out premium, subtract out gain, right? Working capital, net capital expenditures, right? Always 4 negatives. So if I'm looking at cash flow from operations, just like what we just saw, it includes what? All of this. It includes net income. It includes working capital, right? And these are all included. So what is not included? The E, which is net capital expenditures, and the B, which is net borrowing. So if you give me CFO, which accounts for everything that's actually circled, meaning the net income, sorry, that line should go there, the net income, except for those two items, then the formula for free cash flow to equity is just then what? Is just cash flow from operations, subtract out any fixed capital investment or capital expenditures, and add back any net borrowing. So let's take a look how we did. Right? To arrive at free cash flow to equity using cash flow from operations, I would just do what? Subtract out the capital expenditures, add back net borrowing. Right? If I know the big formula and I can just see what makes up cash flow from operations, I know exactly. I don't need to memorize additional formula. I need 2 mnemonics, and I'm on my way, right? And remember what those mnemonics are? It's a nice tip, and it makes you what? Glad, right? And the thing is that, or the other one, free cash flow to equity, being a newbie, and you have a tip, makes it glad, right? Here we go. All right, I know it may not be the most fun mnemonic, but you can jumble them around yourself and make up whatever. If you're a big Scrabble fan, you could probably find something perhaps more interesting. All right. Now, so looking at free cash flow to the firm, beginning with earnings before interest and taxes, or EBIT, we show the relationship between EBIT and free cash flow to the firm. Notice this is our initial equation starting with net income, but net income also is what? Earnings before interest and taxes. If I'm getting from earnings before interest and taxes, I want to get to net income. Well, then take EBIT, take out the tax, take out the interest, right? So that's what we're doing here. We can take EBIT minus the interest, 1 minus the tax rate, or separate the two. Keep in mind, this looks familiar, right? That's basically what we add back to free cash flow to the equity. So if I never subtract it out, I don't need to add it back. So you'll see the formula here, EBIT, 1 minus the tax rate, plus any depreciation, minus working capital investments, and minus any fixed capital investments, or also what we say, non-cash charges. Assume that the only in this case, the only non-cash charge is depreciation. But just to kind of loop it around and make sure that we're on the same page here, we can still do this from our mnemonic. What? You got a nice tip, glad, right? And just think about it. If I have EBIT, earnings before interest and taxes, right? Well, I have net income. That essentially is earnings before interest and taxes. But EBIT doesn't have the tax, so I'm just going to go 1 minus the tax rate. So earnings before interest and taxes, 1 minus the tax rate, takes into account what? Net income and the interest. Because this is what? Adding back interest 1 minus the tax. So earnings before interest and taxes equals the first two, as long as you multiply it by 1 minus the tax rate. This equals that, right? Oh, I didn't mean to circle the C. Should just be these guys, right? Those two items. So if I have EBIT, then that means it's just the C, the E, and what? The non-cash charges, right? Which is your tip glad. All right? Let's take a look how we did. So it's the C, the E, and your non-cash charges. And remember which ones were the negative before we move over. Your negative ones are your P, your G, and your C, and your E, right? Your C being your net capital, your C being your working capital, and E being your net capital expenditures. Let's take a look. So notice depreciation representing the non-cash charges, your working capital, and your net capital expenditures or fixed capital investments. And there's your earnings before interest and taxes. Still can be achieved through the mnemonic. What about free cash for the firm beginning with EBITDA, earnings before interest, taxes, depreciation, and amortization? So no depreciation, no amortization. So in free cash for the firm, I have EBITDA plus the depreciation. Because notice, we had to add back depreciation, right? Because that's part of the non-cash charge. So just in a simplistic standpoint, we had to add that back. However, while EBITDA already added it back because it's earnings before the D, the depreciation, the problem is that we still had essentially a tax savings on that depreciation, which does represent cash. So we have to make that adjustment. We have to essentially add that tax shield back because that, while we add depreciation back, the tax shield was in net income, but it is not in EBITDA, right? Because it doesn't have the tax effect. So we add back non-cash charges, or in this case, let's just assume the only non-cash charge, depreciation, times the tax because we capture the tax benefit from deducting that depreciation, right? And so you can still do the exercise going down as far as the net income through the mnemonic. You'll just notice that I scoop up the depreciation, which is part of EBIT, but there's that tax piece associated with it. And we'll do some examples in later slides. All right, so your free cash flow formula review. Look at all of these here. Bunch of formulas to know. And there's, and if you want to, there's the mnemonic what? What's the mnemonic again? Nice, tip, glad. And let's just see if we remember how to do this. What does the N stand for? Net income. What does interest stand for? Interest 1 minus the tax rate. And which ones were the negative? There's 4 negatives, right? The C, the E, the P, and the G, right? C being what? Working capital. Subtract that out. Capital expenditure. Subtract that out. Your taxes, your deferred tax liability. Add that back. Impairments, add those back, right? Premiums, subtract out. Gains, subtract. Losses, add. Amortization and depreciation. It's always great if you can practice, you know, write that out a couple times, then it's yours, right? So, you know, when you're out and you're, you know, going on a date, just write it on your napkin, you know. If your date's saying something, you just, you know, start writing that formula out. It just, as you do that, then guess what? You're going to love this part of the exam because then you just pick and choose. If they give you EBITDA, just determine what did you give me in this giant formula that equates to that, and your answer is just going to pop out. Let's take a look at your free cash flow to equity formula review. So you have your net income, non-cash charges, your cash flow from operations, your non-cash charges working minus any working capital changes, your fixed capital investments, and adding back any of your net borrowings, right? And then going from cash flow from operations, you add back any fixed capital investments and add back any net borrowings. And remember, what's the mnemonic for these? For this one? Newbie, tips, glad. All right, newbie, tips, glad. Which ones are the negatives here? Just as a quick review, is the E and the W. Oh, there's no S. Sorry about that. The G and the P, right? All right, so newbie, tip, glad. Just to do just the front part here, this is what? Net borrowing. Net borrow, right? This is working capital. This is capital expenditure, right? Starting with net income. So, same thing with free cash flow to equity. You can run these through, compare them. If you're able to write this out, you're going to be way ahead of the game. All right? Now, important concept for free cash flow to the firm and free cash flow equity. There's only one value for free cash flow to the firm and only one value for free cash flow to equity, regardless of how you calculate it. Because why? You notice it all comes from the same formula. It's the same formula going up and down. It's just parts of it are just taken in groups, right? The various equations are all different ways to get to the same value, whichever equation is easiest. So whatever makes it easy. For me, I just like to write the mnemonic and just fill it in. What I do is I write it out. If the vignette's telling me I need to calculate that, I'm like, yeah, great, fantastic, love you. And so I just write it out. Then I go into the financial statements and I become a terminator. It's just checking the boxes. All right, I just need this answer. I need this number. I just need this number. And as I go through the vignette, I'll even start labeling things because when you go through the vignette, it's probably a good way, the best way that I believe that when you go through the vignette, you want to go look at the questions first, so that way you know what you're looking for, right? So probably around the first 3 questions, that's typically what I would do, and then start reading the vignette. So that way I can start collecting the information that I potentially would need for those questions.